I'm joined now by Navin Lala, an ex-colleague of mine and the client director at Old Mutual Alternative Investments. Navin, welcome.
Cheers. Thanks, Leon.
You are the client director. What does a client director do?
Well, we're looking after clients from a client management perspective, so that includes fundraising, investor relations, and I think a lot of it is about helping clients understand this world of private markets.
So that's the interesting thing because Old Mutual Alternative Investments focuses on private markets alone, or is it broader than that?
We focus on private markets exclusively, so we've got 147 billion in assets under management, 147 billion rand, and it's exclusively in unlisted assets, private markets.
So some people in the audience will say that private markets or unlisted investments are riskier in nature and therefore are not for retirement funds. What would your counter to that be as their client director?
I think it's quite a misconception in the industry. So if you think about to compare to the listed markets, so the JSE or NASDAQ or Wall Street, they're a good clearinghouse where there's price discovery and that's very transparent. However, if you look at the JSE, for example, your listed companies would only publish results every 6 months. So the visibility of earnings and updates on what's actually happening in the business, how strategy is tracking in terms of its execution, profit delivery, earnings, etc. You see that 6 months or every 6 months. Where in the private markets, you are shareholders alongside founders or families, and you are involved in the business from a hands-on perspective. You've got monthly accounts which you'd work through. You're part of the strategy discussion, tracking execution of strategy virtually on a month-to-month basis. So with that visibility and hands-on, I think you don't get a purer form of active management than you do in the private markets.
I would agree with that. Maybe it's unintended consequence, but the consequence of that is you can fall in love with that investment, and it becomes a child. So how do you maintain your independence or your objectivity when investing like that?
So our objectives are very clear from the front. It's that we want to acquire good businesses with strong growth prospects, quality businesses that have a good growth underpin with strong management teams. And we partner with them and we want to make these good businesses even better by assisting the board and the management team in terms of our expertise, our network that we can bring to it. And up front in the conversation, it's that they understand that our mandate is to hold the asset for about, call it, 5 to 7 years.
Sorry, Carol.
Yeah, so they understand it up front, and in private equity, your profits are realized or your investor return is actually realized once you sell. So when we acquire a business, we are already thinking from the beginning what the potential exit is and what the shape of that looks like, and keeping an eye on all the moving parts in terms of the operating environment, macros. But when you're buying good businesses with a strong investment case, typically a lot of them are, no one's immune to cycles, but they're robust enough. They'll have market dominance, good earnings growth, as I'd mentioned. And I think with that, it does dampen some of the risk.
So we've seen the number of listed companies in South Africa dwindle over the last 10 years, more than 10 years, from in the thousands to a couple of hundred ultimately. For the sake of our viewers, private market investments where you have an exit mechanism, the exit mechanism may indeed be a listing of that company. So investment in private markets should ultimately stimulate more public market interest.
Yeah, it should, technically. But what we find is a lot of companies are staying private for longer. I think it can be quite costly and onerous in terms of the requirements for being listed. I think there's a place for public markets, and public markets play a very important role in the, call it, in the funding of companies and the economy. So I think while IPOs have dried up, we'd love to see them come back. It'll create more appetite for or provide for a more elegant, easier exit, and where the broader population or investor base can have access to it. But typically what we found is a lot of the businesses we've exited have been, call it strategics or to international players, where they see this fantastic opportunity in South Africa as a good, stable, emerging market with all the governance and padding, and in many respects, we're very first world.
So encouraging foreign flows into South Africa.
Yes.
Okay. Let's unpack a little bit the concept of impact. It's a theme here at the IRFA conference, building resilience, impact investing, and so on. Impact and private markets go hand in hand, but not or hand in hand. Not all private markets is impact. Can you just expand on that a little bit for the audience?
Yes. With impact, there's quite a few things to consider. So it's about intentionality, about what impact you want to be driving. It could be one of the SDGs, could be employment equity, clean water, climate transition, or clean energy, renewable energy, etc. So it's about being very intentional on what you want to achieve up front, and then knowing how to track it and to manage it, and then, of course, how to report on it. So, for instance, we've got an education fund, which we invest in schools. We've got about 51 schools on the books. It's got capacity for about 47,000 odd learners. And with that, we have a clear understanding of the impact we are achieving in terms of the number of students that are passing through the school, the bachelor pass rates, etc. And they have been above average to what the nationals have been. So I think that's very positive. And the returns, of course, have stacked up.
So what you just said there is important. Impact doesn't mean a lowering of return. You're not foregoing anything. You can achieve superior or competitive returns even in an impact world.
Absolutely. I think if you want to have meaningful impact, it's got to be sustainable. Mm-hmm. And for it to be sustainable, the economics need to stack up. I think there's a place for philanthropic causes where philanthropic funds or family offices, etc., foundations would like to donate money or play in a blended finance role where they would absorb first loss. Where on our side, we are managing monies or funds of pension funds, members, etc., where a return is critical. So I think one should never look at impact at the expense of returns. You can do both, and I think it doesn't make sense not to do it if the economics don't stack up, because then it's not sustainable.
So a couple of quick fire questions. Old Mutual Alternative Investments is private markets, all impact, or some impact, some not impact specifically?
Our whole business has an impact theme. Mm-hmm. We have those where, for instance, our infrastructure business has a well-known fund called the Ideas Fund. It's an infrastructure fund. It has a strong impact in terms of the just transition to clean energy. So we know that it's carbon offset. It's measurable. We know the impact we're having over there. We've got a private equity fund where some of their impact goals is to get more women in the workplace and transformation from that in terms of our portfolio companies to drive a more equitable gender composition at staff level, executive, etc.
So the Ideas Fund is well known. It's been around for a long time. How long has Old Mutual Alternative Investments been in this market for?
I think the genesis of the business is about from 1999, around there.
So Old Mutual Alternatives has been around for a long while. Have you noticed a change in the appetite or the conversation with customers around their attitude towards private market impact investing?
Yes, definitely. Clients are looking for impact. They're looking for different sources of return so you can get more diversification. Mm-hmm. And we've seen lots of interest in our Ideas Fund. It's got a track record from 1999, and it has a stellar performance track record. We're seeing the same interest in private equity and a lot of our other asset classes, like the impact, affordable housing, education, etc. So there is interest, and the uptake in the beginning of a newish asset class is always going to be slow. The industry is going through a learning curve. Some pension funds are at a more advanced stage than others, but the regs only changed 2023. And prior to that, a small allocation of, call it 5%, didn't demand so much attention when the listed markets historically over the past 50, 100 years have been fantastic in South Africa.
Well, it's good to hear that. We, however, as the industry, are very, very good at coming up with phrases that confuse the living hell out of people that don't actually work within the industry. So let's try to help alleviate that a bit by explaining the difference between an open-ended fund, and if I'm correct, the Ideas Fund is open-ended, versus a close-ended fund where you raise capital for a particular point in time.
Perfect. So an open-ended fund would be a perpetual vehicle or an evergreen fund, similar to a unit trust, where it doesn't have a termination date or end date. The close-ended fund, as the name suggests, it'll have a fund life period, typically 10 years. So for the first 2 years, we would be fundraising, and then you'd be deploying for the next 2 to 3 years, and then you'd have the harvesting period and then be exiting, hoping to exit before 10 years. So it's got a finite, it's legally a legal contract in terms of when you need to be exiting the fund and when the fund life ends. So typically you'd find most assets get exited well before then, but there are also instances where sometimes there's a soft patch in the market, or assets need a bit more time to unfold or to be able to achieve the valuation you're looking for. So for instance, if you're exiting during COVID times, it would have been highly problematic, where businesses across the board would negatively impact. So in that sort of instance, it would make sense for investors to protect their interest is to extend the fund life and give the assets some time to recover, together with the interventions our private equity fund managers would do.
But I think it also simplifies the liquidity risk perception, in the sense that you can still access impact investing through various parties where there is a form of liquidity within the nature of the fund, versus a closed-ended fund, which you do need to commit yourself for the full period in order to bear the fruits of that. And pension fund investing is long-term in nature, so that shouldn't be a problem. Absolutely. But obviously you have the different nature of funds, different age profiles and so on. So you guys are catering essentially for both avenues.
Yes. Investing, it's a long-term endeavor. And, if you look at just general equity investing, typically the investment term horizon, it's minimum 5 years or 7 years and beyond. So I think for private equity or unlisted assets, private market assets, having a term of 7 to 10 years, I think it's not too far out of line in terms of what's expected in terms of the investment holding period and, call it, harvesting period to generate returns. So I don't think that's too different. I also think that with the two-pot system, in terms of having the retirement pot being super long-term, private markets are incredibly well placed for those sort of for that pot.
Okay, good. So for anybody that's would like to have a conversation with you around any of this, how can they get hold of you?
Well, you can go to our website, allmutualalternatives.com, and you can pick us up on the website.
And I will post Navin's cell phone number over here 24/7. You're welcome.
Yeah, and my email address. Welcome. Thank you
Navin,
very much for that.
thanks so much for joining us here in our studio. I wish you a good conference further. And anytime you want to come and speak at EBnet, you are more than welcome.
Fantastic. Thanks for the opportunity, and always great chatting.